Welcome to Consumer Lending Perspectives, a podcast where we talk to financial industry leaders about trends in consumer assets, underwriting, performance, customer acquisition, fraud prevention, liquidity, and more. Hosted by Jeff Bogan, CFO at Upgrade and fintech veteran. This show delivers key insights on the topics that matter most to financial executives.
Welcome back. I'm your host, Jeff Bogan. Today's guest is Ethan Heisler, editor of the Bank Treasury Newsletter with its reach of over 1,600 finance professionals. He's also the host for his monthly podcast, BTN. Ethan has held senior positions in fixed income sales and trading, corporate bond research, and bank supervision, and previously was recognized by Institutional Investor as a leading analyst for U.S. and Yankee banks when he was a managing director in the bond research group at Citi. He speaks at forums and dinners across the country. Welcome to the podcast, Ethan.
Thank you. Thank you. Nice to be here.
So what made you start the newsletter?
Oh, well, so funny story. I was in corporate bond research, as you mentioned, and I was this II ranked analyst, and I was having a great time. This is now 2003. You know what happened after 2001? It really was not great to be a bank analyst, certainly not on the corporate bond side. People were like, the thought police, the compliance people, all those people, they would give you a hard time. So, and then they were firing senior people. Like I was a senior analyst. They had just made me MD. And this is 2002. And all of a sudden they're firing senior people. I'm like, I don't want to be replaced by my junior. And a great opportunity opened up on the market side at Citi to be a bank resource guy. So the job was to go with the sales force, the mortgage salespeople and the rate salespeople. We'd go visit all these bank people. And then we would tell, I would go off with the CFO and the treasurer and speak to the board, do all these different things, big picture. And the salesman would try to get stuff done. It was a great gig. I loved it. But the one problem was that since I was a publishing II ranked analyst, I missed publishing things. All of a sudden, I'm going with economists, rate strategists, and mortgage people, and all these people, and they're showing all this research. And I go in front of the customer and I got none. But I couldn't write research because when you're in markets, you can't write research. You can only do that when you're in research. So I came up with a brilliant idea. I called it the Bank Treasury Newsletter. Now it's not research. I don't quote anybody. And you know what? The compliance people never had a problem. So it stuck. So I've been writing it now for 21 years, every single month. Labor of love. But there's always stuff to go on. Like I had somebody when I first started who said to me, I don't understand how you could write something else on a monthly basis. And it's like, this is like, banks are like paint peeling on the wall. So, when if you could actually come up with new things to say for 21 years every month, but it's been true. It's like, it's so crazy and it's so amazing. I'm telling you, I'm in the industry 44 years. I have never seen it more interesting than it is right now. It's just
that's what I was going to ask. What are you writing about now? Like what's the hot topic?
Oh, well, I come up with different ideas as this stuff comes up in the market. A couple of months ago, I wrote about stablecoin, and I deep dive on this stuff, and that was fascinating. And then 2 months ago, this month I just put out a piece. Well, so obviously the Fed as we were talking, the Fed had just cut interest rates by a quarter point, and so. Since Jay Powell is kind of the man, the myth, the legend at this point, and pretty much, the man of the hour all month in terms of conversations and where he's going and what's going to happen. So I put in a picture in ChatGPT of Jay Powell. And I said, draw me a dotted, connect the dot picture of Jay Powell. And it spat out this thing that's in my newsletter this month. And the whole point of the newsletter was bank treasurers tried to connect the dots. They tried, but they can't. Because the problem is that today, there's so much different confusing information that's out there. I mean, like you have different data and it conflicts with everything else. And that's what the Fed people were talking about. They don't know. So it's, Yeah, I mean, this month, it was about confusion. Last month, it was about deposit insurance. The month before that, it was about stablecoin. And, I try to keep it topical and fun. And my newsletter is big picture. It started as a Ethan's blog. What are bank treasurers and CFOs talking about when I speak to them? That's what the job really is, what everybody else is thinking about.
Yeah, yeah, definitely. And then speaking of data, it's unclear what data we're even getting these days. So it's interesting. On stable coins, we do have a kind of a lot. We are a fintech. Can you just tell everyone kind of what a stable coin is and what role you think it's going to have in the banking system?
Well, I mean, it's an interesting question. So a stable coin. Well, I'll give you the story analogy first. So people are, well, the bigger picture. This is the day and age of instant payments. Everybody wants to pay everybody instantly.
With no
And
cost.
well, yeah, I mean, don't write checks. Checks are out, and I want to do it instant. So not ACH. We have things like ACH, automated clearinghouse, same day automated clearinghouse. We have various different things, but I still want to do it in a nanosecond. So the Fed has something called Fed Now, where you can make an instant payment. There's other services that can do that, but let's say that you want to pay somebody, you're in Abu Dhabi, and you want to buy a corporate jet for $50 million on Saturday. Okay. And the guy wants payment right now. You could actually send that person a stable coin without having to go through the whole rigmarole of doing a cross-border payment. So I think that the long-winded answer is I think that stablecoin's biggest application is in cross-border payments. So
What
give
about
just no, hold on,
compliance?
hold on, hold on, hold
Yeah.
on. Here's the number headline. Okay, cross-border payments in 2024, according to the IMF, was nearly a quadrillion dollars. Think about that. I had to Google the word. I wasn't even sure. Is
How many
quadrillion,
zeros is
what
that?
was that? It's 1,000 trillion. So a quadrillion, of which 80% passes through a bank. And think about what the stable coin is. It's like, I don't know, does anybody here know what Star Trek is? Probably. Okay. So you go into the transporter room, right? And the transporter room turns you from a human being into little molecules or whatever, atoms, and it sugars you down to the planet, and then it reassembles you. That's stable coin. And as a bank, I can charge you coming and going. Oh, it's huge. For the banking industry, they're looking at it as a big disintermediator of banks. But really, I don't think so. I think it's just an alternative way of making payments. And you know what payments are? Money that you no longer have in your account. So it just goes to somebody else's account. So
So do you
I
think
think there's a
bank
lot of
treasurers,
opportunity.
yeah,
Huh?
I was say, do you think bank treasurers should be looking at stablecoin and what
I've
role it
been
could play in
talking
their
to them.
bank?
Small banks are really don't have those kinds of customers. The larger banks, like the Jamie Dimons of the world and Brian Moynihan's and Jane Fraser of Citi, Wells, those guys, US Bank, I would think those guys are all over this stuff. But, people are still trying to learn what it is. Like you
Right,
asked the question, what's a stable coin? Well, it's a
right.
cryptocurrency backed 100% by US Treasury bills or cash, but it's
Yep,
completely convertible back into cash at 100
yep,
cents on the dollar.
yep.
So it's not like Tether or those other things that blew up in the past because it's tied specifically to Treasury bills. And then it's also something that's issued from a trust, which is separate from the bank, but which the financial institution actually earns the interest on the Treasury bills because it doesn't pay an interest payment to the stablecoin holder. Very interesting stuff. I totally recommend people get up to speed on it because it's not going away. These topics are going to grow on you.
And do you think it'll lower the cost of transfers? It has to, right? Or is it more
300,
about the
I
speed?
think it was something like, according to the study I saw, $370 billion in revenues from foreign exchange. It's going to do a lot of disrupting. Oh, yeah.
Fascinating. Well, what do you think? So for the smaller banks and credit unions out there, they definitely need to understand stablecoin. But what do you think should be top of mind for treasurers these days? You
I'm
said there's a lot
asking
of
every
confusing
treasurer I
data.
speak, I
Yeah.
ask every treasurer I speak to, I say, tell me, or CFO, how are you using machine learning AI? And they'll all tell you, oh, we're using it in processes, we're doing this, we're doing that. I'm saying, I'm not asking you like, that. I'm asking you, how are you using it to make better decisions? And no one really has thought about that. But I'll give you another analogy. You know the iPhone? The iPhone in 2007 was something nobody really thought they needed. I have a phone. Okay, why do I need this? But once you got it, it's changed the way we think. We operate differently than we ever did before. I never thought of a smart, and it's only 17 years ago that we actually started to have this technology, but it's changed us because we think better. We Google things now when we're at dinner to look up, well, who was that actor who said that? Things like that at the dinner. And I think that AI needs to seep into our consciousness in the way we think. So to me, machine learning AI is like one of at least the application I'm thinking about is one where, let's say you go to a casino and you sit at the blackjack table, and the blackjack dealer has 1,000 decks that they're dealing from. And this thing can allow you to calculate the odds of pulling an ace of spades. Now, it's not going to tell you that you're going to pull the ace of spades, but it is going to give you an insight of what the odds will be of getting an ace of spades. And that's helpful.
Right.
So I think that for bank treasurers and CFOs and risk managers who are just learning very new technology, but thinking of it in terms of just how can I, get more efficiencies? No, no, no. How can you enhance your brain to do more with what you think? Think of it as you work in a warehouse, and you put one of those exoskeletons around you and you can lift heavy boxes. This is something similar for your brain.
So if you're managing balance sheet risk, like how can AI and machine learning specifically help you better manage balance sheet risk, for example, either in your investment portfolio, loan portfolio, et cetera?
Think about Silicon Valley Bank.
Yes.
Think about Silicon Valley Bank and thinking it's 1 in a million that we're going to get into trouble. We've got capital, we have guaranteed securities on our balance sheet, we don't have any credit risk of any real consequence. So what's the problem? Well, maybe when you put these deposits in, you think that they're 3 or 4 years. Well, what if I told you that they are 3 or 4 years, but if it happens and that happens, all of a sudden they might be overnight money or instantaneous money. Well, now I might think a little bit more about, so I bought these 3-year mortgage-backed securities. Maybe I should have gone for the Superfund sequential. Things like that.
So let's say every bank had that type of analytics and they were thoughtful about that potential risk exposure. Like what happens to these mortgage bonds then, these longer term mortgage bonds? Where do they sit if they can't sit on a bank balance sheet
I
because of
don't think
liquidity
banks
or
have
it's a
been the
smaller
big
proportion
banks.
or
Banks are not buying the big mortgages like they were. First of all, I mean, I think that everybody today, even without Silicon Valley, I think everyone has come to the realization that, whatever liquidity I had on my balance sheet, I'm going to need much more liquidity on the balance sheet. One reason because of, I like this, as I mentioned earlier, instant payments. Instant payments are leading institutions to hold more liquid assets on their balance sheet because let's say you get a payment over the weekend. You can't go to the capital markets to go ahead and sell some bonds. You better have some cash in your reserve account in order to make those payments. So people are sitting with more liquidity. I think that where they're going is mortgage-backed securities are going to continue to migrate out towards pension fund, hedge funds, private equity, private credit, whoever's looking for investments that way. Banks are not they're not getting rewarded by their shareholders for taking on more mortgage-backed securities. Banks are getting rewarded for investing in loans and funding loans and getting some real spread, which is really being the question.
Well, I mean, just, if you talk about stable coins and instantaneous payments and so forth, I mean, is there a reason why you couldn't get liquidity over a weekend in the future, if that's the concern?
Capital markets are closed on the weekend.
They are right now,
Now,
but,
well, yeah, we could.
you know,
Um, we could. So at that point, that would be interesting. Right now, Fed now operates on the weekend. It operates 24/7, but the discount window doesn't. The home loan banks do not. The rest of the capital markets don't operate that way. We are just now adopting T plus one. So, there's that. Um, the Fed still has a proposal they've not put through completely, which would enable the Fed wire to be open 22/7, so 22 hours a day, 7 days a week. But that's still not been implemented.
interesting. So in the meantime, your choices are hold more liquidity or hold more liquidity.
Yeah, and so far it's been not a bad deal, right? The Fed pays you to hold liquidity at the Fed. That's like great.
Right, right, right,
I mean, think about it this way. If you look at the yield curve, right now the yield curve is steepened a lot. But um, up until out 5 years or so, the front end of the yield curve is still actually higher than the long end of the yield curve. Like if you go out to 5 years, you're still inverted from like 1 month out to 3 months, out to 5 years, out to 2 years. So I'm still kind of paid to sit in cash.
right. Yeah, why take duration risk on that?
Oh yeah. I wish this can continue. Personally, it's great. I have a whole portfolio of 1 month treasury bills. Everything I do is just get up in the morning once a month and look at my Treasury Direct account and just roll the money. It's like
Yeah,
no thought.
yeah. What about on the liability side? I mean, deposits. What's the future of deposits for banks that you're seeing? And in the whole broker designation, right? I mean, do you still think it's right to think of brokered versus non-brokered deposits relative to the risk that it presents to the institution, particularly in light of SVB, when their core deposits left overnight?
So right. So I think SVB is a very bad comp to this conversation, and not I think the topic, what you're really asking is, are uninsured deposits, should they be looked at as core deposits? Well, it really all depends. Just like everything else, it's a label that we attach to a word, to something that's much more complex than just uninsured deposits. For example, there's operational deposits of large corporates. They leave the money there. It ain't going anywhere. The reason why they leave it there is because the bank helps them pay their payroll. I mean, what I wrote a couple of months ago was that one thing that really would help deposits for banks would be a better deposit insurance system. We need maybe more deposit insurance. Right now, you're insured up to $250,000 on your account. But when that rule was made in 2010, they've had this thing called inflation. So that 250,000 is no longer worth 250,000. It's probably, if you wanted to get an equivalent today, you'd have to have something closer to 375,000. But Congress hasn't been acting on things like this.
So, in light of that, then, in your discussions with treasurers and CFOs, with respect to their conversations with regulators, how has that evolved over the last 2 years? Are the regulators asking different questions? Do they have different requirements, different concerns?
Well,
How has
right
that
now,
evolved?
well, okay. Are you asking about bank examiners or
Yes.
regulators?
Yeah, bank
Bank
examiners.
examiners, well, these days it's hard to find bank examiners because they've lost so many and they've fired
Right,
so many. So,
right.
and the kids and the people that you're meeting, the biggest thing you hear, and I'm sure this is no surprise to any of your listeners, is that the people that you're talking to are not the same people you met last year, because you're getting the same 25-year-old kid that's coming in with no experience and supposedly leading the charge without much direction or help. So, That's definitely a group of people that could use artificial intelligence, machine learning to help them in their examination focus, using it to analyze an institution ahead of time to determine where the weaknesses are, and then being able to direct your limited resources and exam force towards those problems, as opposed to the way they normally do it, which is to just throw everything at everything and then come up with something.
Sounds like a good idea for a new fintech to invent a business model that helps
It's called
regulators with that
RegTech.
data. Yeah,
RegTech.
RegTech.
You
Yeah,
know what the
exactly.
biggest problem with all of this is, and I've worked with my newsletter. I have a number of sponsors, a number of corporate sponsors. One of the things that and they're all like fintech tech companies. One of the things I've really learned about fintechs is you can come up with the best idea in the whole world. It doesn't mean because you build it, they will come. You still have to convince people that it's something they want to use. And that takes a lot of convincing. And treasurers, man, those people are stubborn. But even worse, their boards are stubborn. And even the people they do talk to at the examiner force, those people are not imaginative.
Right. So you need better tools, but it's hard to get adoption of that.
You need a whole generation to die out in the desert, and then the new ones come into the promised land. I mean, it's
Well,
like
that's why
this
we're
is
having
just
this
going to be it.
podcast. Yeah, we're giving some people advice on how to evolve and move on and better manage their risks.
And I
So,
think people are going to change over time, the same way that we did with the iPhone. This is going to become more and more ubiquitous. I mean, like, think about even like your Google searches lately. I mean, how often, 15 years ago, you wanted to do a Google search and you had to put in these keywords and you had to separate them with commas. Now I can write an incoherent sentence and the AI can actually figure out
right,
what I'm asking.
right. It's amazing. It's absolutely amazing. So, are there new exciting strategies for sourcing assets and even liabilities for banks? I mean, I know we've talked about you need more liquidity. What are you seeing on either the asset or
Oh,
liability
listen,
side in terms of
so
innovative
one of
ways
my corporate
to source
sponsors,
that?
Upgrade, is an interesting example of that. I mean, they're
Yeah,
originating assets that, instead of having to have a bank have the expertise in originating a consumer loan, but wanting to be able to add some of the profile in their mix, you can do that. I have another corporate sponsor, Orson, ORSNN, that has a what I like to think of as a dating website for residential home loan buyers and sellers. So, but the beauty of these ideas is that, yeah, I can actually source assets. I can source liabilities. RMT, Rich and Tang, another one that, hey, I need deposits. Stone Castle, another one of my sponsors. Though I'm not to plug them, but all of these guys are basically involved with those exact ideas. Um, you know, it's just, I think of this as opening up for financial institutions something that consumers have today. The ability to go on a website and find things. And you don't have to buy it. You could just search and, oh, I like this or not like it. And it doesn't cost you 15 million phone calls. And it doesn't cost you favors with dealers. And there's transparency around it too. So I like all those things. I think that's where treasurers want to go. But you got to get used to it. You got to get comfortable with it. You're used to the dealer going ahead and breaking up and cutting up your pieces for you and then giving you exactly what you wanted. Maybe you have to learn to go ahead and make your own coffee now at Starbucks, which they don't let you do anymore. I don't understand that. They used to let you pour that.
yeah. No, I think with banks, there's a ton of opportunities there, but you have to have the right training and expertise to know how to manage programs like that. And I
But
think,
a lot of this, I
yeah,
don't need to know. I have a lot of training to use my iPhone, and that's a pretty
right,
complex instrument. I
right,
mean, it's. I think the old school, like when I went to college in the '70s, like they had not that. It was the second half of the '70s. No, I'm not that old. But when I went in school, then they still had these things called punch cards. The thought of going to a computer lab broke me out in a sweat. Thank God I was a philosophy major. But Today, a lot of that stuff is just internalized. It's in the machine already. And the interfaces today allow Gen AI to allow you to get the answers without having to spend a lot of time trying to do the technicals. So I think it's just growing comfort with like, oh, this can actually do this for me. I mean, I would never let my car drive itself. But maybe I will try to press the parking feature on the BMW next time. I
Right.
don't know.
No, I think that's right. It's more comfort because it's not difficult to buy assets, onboard the assets, and have someone else service for you. It's more comfort internally that you understand the risks and that you can communicate with your boards and your examiners and so forth to do that. I think that's a much better analogy. That's right. Yeah. So what do you think is going to happen next year with the bank market? So we're going to get a little more stability with interest rates and tariffs and everything else going
Yeah,
on,
well,
or
I mean, you asked me earlier about deposits. So deposits last month, domestic deposits, according to the FH, got over $17 trillion. So that's up $1 trillion from the low after Silicon Valley Bank. So it's at a record. It's never been this high. Meanwhile, loans are growing as well. So um, the real question for the bank market is what's going to happen with the economy in the next 6 to 12 months? What's going to break? Will something break? Or will it continue to defy, every single prognostication that thing was going to get into trouble? I'll give you a couple of thoughts on this. Number one, up until this whole business with the stupid tariffs and all this other nonsense is creating an unnecessary, in my opinion, unnecessary volatility. Up until then, I would say that when the Fed and the federal government did all this stimulus during COVID, it created about $5 to $6 trillion of additional money that went into the system instantaneously. And the last time, when you think about relative to GDP, that was on the order of around 15% of GDP. The last time we had anything close to that concentrated was World War II, when we spent our way out of the Great Depression. And I say this because I don't think economists have ever fully appreciated the power of what occurred. And so every time you thought the Fed could raise rates to 5.25%, 5.5%, and think that that could kill the economy, it didn't, because the economy was on jet fuel. In World War II, the US economy after World War II boomed for 25 years, and that was coming out of a Great Depression. We weren't even in a Great Depression. None of those great damages that was caused by the Great Depression occurred this time, because the Fed acted faster. So therefore, my thesis is that left alone, not screwed up, the US economy is on a solid course for a long time to come. Notwithstanding all the demographic issues like, people aren't making babies anymore, the population is shrinking, all these other things that are going on. But, there's pushes and takes. If we didn't have these immigration business, maybe we would have the people to do this stuff if we really needed them. I don't know. So where do I think the banking landscape is in the next 12 months? I think the Fed is probably not going to be cutting much further. There doesn't seem to be any appetite among the FOMC or the voters that are even coming in to cut rates, much less we had one voter today who even said they didn't want to cut rates at all. So I think we'll still be very confused about data. I was just talking to somebody before this call. We'll still be confused about, well, what is the data actually saying? And I think in such an indecisive world, we'll see volatility. We'll continue to see that. And financial institutions, treasurers, CFOs, risk managers, what are they going to be doing? Not taking too much risk. And you know what? A lot of the risk they take isn't worth the risk that they're taking anyway. Look at the corporate bond market, where corporate bond spreads are at all-time lows or back to lows. You're not getting paid to take corporate risk, really. And that's the, if you follow those rules and you think in terms of what's best for your shareholder, getting return on equity, on risk equity, getting that additional return, that should be tattooed on your head whenever you buy anything or do anything. And I think that the banking industry is still going to be confronting the fact that, you know what, the genie's out of the bag, and money is leaving, is not there. There's money still growing in the banks for deposits, but a lot more money is going outside of the deposits. It's going, like for me, into my treasury bills through treasurydirect.gov, which is just definitely disintermediating the banks for anyone who would think about it. And it's going into money market funds.
And to go back to where we started, isn't some of the risk that it flows to these stable coins that are outside of the banking system?
No, because stable coins are just dollars in your pocket and they don't pay interest. And there's all this talk around how some of these non-banks could issue a stable coin that gets around that with offering coupons and travel benefits or whatever it is. I mean, I don't know about you, but that doesn't sound like the kind of interest I really want to earn, or most people would go around doing. So no, I mean, I as much as I have enough cash in my bank account, in my checking account, to pay the bills for the cycle that I need to pay them for. That's interest free. So any money that would be interest free, maybe I'd put some of that in the stable coin, although not really, because it's not better than doing instant payment or whatever it is, or just take an extra day and pay it. But I think that it actually, like I said, I think it offers a tremendous opportunity to some of the larger banks who are involved in cross-border payments to be able to make more money with less capital. Because if the stable coin is money that's off the balance sheet, you do not have to hold capital for credit risk like you would for a treasury bill that you would own the balance sheet. Because all the money is in a trust that's off the balance sheet.
Yeah, that makes sense. So the story is uncertainty is here to stay. Stay liquid, invest in AI and ML, and be open-minded about that. And also consider partnerships and growing a bit more comfortable there. Any other big takeaways for our listeners?
No, I think that pretty much sums it up. I mean, it's just stay tuned. There's new news coming tomorrow, and it's going to be very interesting. That's for sure.
Yeah. Good. Well, Ethan, thank you for being our guest on Consumer Lending Perspectives, brought to you by Upgrade. We always welcome your emails to investor@upgrade.com on guests and topics. Be sure to subscribe to all notifications about future episodes. And until next time, I'm your host, Jeff Bogan. Thanks again.
Thanks for listening to Consumer Lending Perspectives. Subscribe for more expert insights and strategies from finance leaders. And share the show with your network. Until next time, stay ahead in the ever-evolving world of consumer finance.